Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So the past week has been pretty busy from a news standpoint. We are starting to get S&P 500 earnings information, and the initial expectations of the experts was that S&P 500 earnings would be down anywhere from 2.6 to 3% in the first quarter. And as we're starting to get data, it doesn't look like it's going to be nearly that bad. It looks like it's going to be closer to 1%. So that's actually a good thing. And the reason that we're not too concerned about S&P 500 earnings falling is that last year earnings were goosed a little bit by the tax bill, and we don't have another tax bill this year, so we really can't expect that kind of stimulus to, energize earnings this year. So we expect earnings to be down a little bit this year, but not a lot. And what we are starting to see is more in line with what we thought than what the experts thought. The other data that we're starting to see has to do with first quarter GDP. And this is actually pretty exciting because the Atlanta Fed just 6 weeks ago had come out with their estimate that they thought that first quarter GDP growth would be 0.3%. And that, if true, would have been the fourth quarter in a row of pretty substantial declines in GDP. Well, they just updated their number here in the last few days, and it's gone from them thinking that it would only be up 0.3% to their new estimate of 2.8%. Now, 2.8% is a good number. That's basically the average for what it was all of 2018. So if that number holds true, then we are not at all concerned about GDP. We don't think a recession is coming. All this hype spurred on in part by the numbers that the Atlanta Fed put out 6 weeks ago is really concern over nothing. So we're going to watch the data pretty closely. We'll see where those first quarter GDP numbers come in, but we're not at all concerned now, especially since the GDP number from the Atlanta Fed is more in line with what we thought it would be, which was somewhere between 2.5 and 3%. So in any case, that's not what I'm here to talk about today. Today, what I wanted to talk about is something that I have been seeing as I've been meeting with people that are near retirement, planning on retirement, or recently in retirement. And that is that some people get to retirement basically saying to themselves, I'm going to pay off my house and I'm going to contribute to my IRA so that when I retire, I'll get my Social Security and I'll have enough money to live. And that's partly true, but it's also partly not. And here's the problem. Let's say somebody has $500,000 of equity in their house and they retire. Well, can you actually get that money out of your house without getting a home equity line of credit, selling your house, or getting a reverse mortgage? And that answer is no, you can't. So while equity in your home is interesting, it isn't like the primary goal, because if you don't have enough liquidity in retirement, that's actually a bigger problem. So let's add to this equation that they have $500,000 in an IRA. Feeling pretty good about that. $500,000 is a lot of money. So they're taking, let's say, $1,500 a month out. That's $18,000 a year. And then all of a sudden they want to do something. They want to take a cruise. So they spend $20,000 on that. And then their home needs some repairs. There's another $30,000. And now all of a sudden they've had to take, $65,000, $70,000 out in a single year. Oh, wait a minute. In order to net $65,000 or $70,000, now you have to take $100,000 out. So now your $500,000 IRA is down to $400,000. And Murphy's Law being what it is, the market's going to be down 10% that year. So now your $400,000 is down to $360,000. So you're 2 years into retirement or a year into retirement, and you thought you were all set because you had $500,000 and now you have $360,000 and you're wondering, do I need to go back to work? So the biggest problem that we see in many cases is that people do this great savings to pay off their house. They do great in putting money in their IRA, and they forget to keep sufficient liquidity outside of those two assets so that they can live their life how they want to in retirement and not have to take large distributions from an IRA. Because the bigger the distributions from the IRA, the more tax bite the government's going to take, the faster that asset gets depleted. So you really want a balanced approach. Think of it as a three-legged stool. the home equity that you have is important, because if you sell your house and you have all that money and you want to be a renter or you move somewhere else, that equity is going to be really helpful. If you have money in a retirement plan or in an IRA or a Roth IRA, as you take money out of those accounts, that can help supplement your Social Security, and your tax rate will be relatively low on modest distributions, so you can live a good life there. But if you need extra money, you really need to have liquidity outside of those two in non-retirement and non-home equity sources, so that when you really need money and you want to go do something extravagant, you're not having to sell things and pay the government a large tax bill. So if anybody has any questions about that, or would like us to go look over their stuff to see how well they're prepared for retirement, or if they're doing the right things to be prepared for retirement, give us a call. We'd be happy to help. But in the interim, that was your update. I hope you liked it. If you did, give us a like, give us a share, and I'll be back next week with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.